Here's what an index fund is, in one sentence, before I explain anything else. It's a single investment that buys a tiny piece of hundreds or thousands of companies at once, automatically, for an almost invisible fee. That's it. Instead of trying to pick which company will win, you buy all of them in one purchase and let the whole market carry you. When you hear an S&P 500 index fund, that's one fund holding a slice of 500 of America's biggest companies. Buy it, and you own a piece of nearly the entire U.S. economy. This one boring product is how an enormous number of ordinary people, teachers, nurses, mechanics, quietly become millionaires over a career. Not by being clever, by owning everything and waiting. The rest of this video explains why it works so well, why even the professionals can't beat it, exactly how to buy one, and the traps to avoid. But you already have the definition. Let's build on it. I'm Mr. Finance. I put real numbers on the money moves everyone mentions, but nobody explains slowly. If that's useful, subscribing takes one tap. Now, what's actually inside the box? Let's open the box. An index fund is built to copy an index, and an index is just a list. The S&P 500 is a list of 500 of the largest U.S. companies. A total market index is a list of essentially every public U.S. company, thousands of them. The fund's only job is to hold everything on that list in the right proportions. No genius stock picker choosing favorites. It just owns the list. So when you put $100 into an S&P 500 index fund, that $100 is quietly spread across all 500 companies at once, a few cents into each. You instantly own a microscopic piece of hundreds of businesses, the tech giants, the banks, the retailers, the energy companies, the whole engine of the economy, in a single click. This is the first magic word in investing: diversification. By owning everything, you're protected from any single company blowing up. If one of the 500 goes bankrupt, it barely dents you, and the index simply drops the failure and adds whatever rising company replaced it. The fund is self-cleaning. Losers fall out, winners rise in, automatically, forever, with no decision from you. Compare that to buying a single stock. If you put your money into one company and it stumbles, you're hurt badly. Own all 500, and you no longer need any single one to survive. You only need the overall economy to keep growing over time, which across every crash and recovery in U.S. history, it has. That's a dramatically safer bet than picking winners, and it's the entire idea behind index funds. Here's the fact that shocks most beginners, and it's the strongest argument for index funds ever made. Professional money managers, people paid enormous salaries to pick the best stocks, with research teams and supercomputers, mostly fail to beat a simple index fund over the long run. Not some of them. The large majority of them over periods of 10 years or more. Read that again. The experts, trying as hard as they can, usually lose to a fund that does nothing but own everything. How is that possible? Two reasons. First, the market is made up of millions of smart people all trading at once, so it's extraordinarily hard for anyone to consistently outguess the crowd. Second, and this is the quiet killer, the pros charge high fees for trying. Even when a manager does slightly beat the market, their fees often eat the difference and then some. The index fund wins not by being smarter, but by being cheap and by refusing to guess. This flips the whole story of investing on its head. Most beginners think successful investing means finding the person or fund clever enough to beat the market. The evidence says the opposite. The winning move for almost everyone is to stop trying to beat the market and simply be the market at the lowest possible cost. Buying the index isn't settling for average, because that average quietly beats most of the highly paid professionals trying to do better. Legendary investors agree. Warren Buffett, one of the greatest stock pickers who ever lived, has instructed that after he's gone, the money he leaves for his family should be put mostly into a low-cost S&P 500 index fund. The best stock picker on Earth's advice for ordinary people is, don't pick stocks, buy the index. That should tell you everything. If you remember one number from this video, make it this one, the expense ratio. It's the annual fee a fund charges you, expressed as a tiny percentage, and it is the difference between a great index fund and a bad one. Good index funds charge almost nothing, often 0.05% or 0.1%. That means for every $10,000 invested, you pay $5 to $10 a year. practically invisible. Bad funds, including many that look similar, charge 1% or more, which sounds tiny but is 20 times higher. Here's why that tiny difference is enormous. Fees compound against you exactly the way returns compound for you. Over a full investing career, paying 1% a year instead of 0.1% can quietly consume roughly a quarter of your final balance. On a portfolio that would have grown to $1 million, that's around $250,000 handed to a fund company for doing nothing you couldn't get far cheaper. So when you choose an index fund, the single most important thing to check is that expense ratio, and to make it as small as possible. The good news, the biggest, most popular index funds from the major providers already charge next to nothing. You don't have to hunt. A broad S&P 500 or total market index fund from a major low-cost provider will almost always have a rock-bottom fee. Just look at the number before you buy, and never pay 1% for something you can get for 0.05. This is the honesty anchor of the whole topic. Index funds are powerful because they're cheap. A high-fee index fund throws away the main reason index funds work in the first place. Cheap is not a compromise here. It is the entire strategy. Knowing what an index fund is means nothing until you own one, so here's exactly how, in plain steps. First, open a brokerage account, free, about 10 minutes, at any major U.S. provider like Fidelity, Schwab, or Vanguard. If this is long-term money, opening it as a Roth IRA lets the growth come out tax-free later, which is a powerful bonus. Move some money in from your bank. Second, decide what to buy. For most people, 1 or 2 funds is genuinely enough. A broad S&P 500 index fund, or an even broader total U.S. stock market index fund. Either one gives you the whole market. You do not need 10 funds. That just recreates the whole market with extra steps. One good broad index fund is a complete strategy on its own. Third, buy it, and this is the part that builds wealth. Set up an automatic monthly investment. The same amount every payday, buying the same fund forever. When the market is high, your money buys a little less. When it's low, it buys more on sale. This is dollar cost averaging, and it quietly handles the timing you could never guess. You don't watch the market, you don't react. You just keep feeding the fund and let it grow. And a note on how much. You can start with $50. Fractional shares mean you don't need the full price of a share. The starting amount barely matters. The consistency is everything. $50 a month, every month, for decades, beats $1,000 once and then nothing. That's the entire process. Open, buy one broad fund, automate, ignore. Most people massively overcomplicate this. The simplest version is also the one that works best. Once people understand the basics, 4 questions always follow. Let me answer them fast and plainly. ETF or mutual fund, what's the difference? You'll see index funds sold in 2 wrappers, and for a long-term beginner, the difference barely matters. An ETF trades like a stock during the day and often has a very low minimum, so you can start with just a few dollars. A traditional index mutual fund is bought once a day at the closing price and sometimes has a minimum to start. Both can track the exact same index at the exact same tiny fee. Pick whichever your broker makes easy. The important part is that it's a broad index at a low cost, not which wrapper it comes in. How many companies should I own? One good broad fund is enough. An S&P 500 fund gives you 500. A total market fund gives you thousands, including smaller companies. Either is fully diversified. You do not need to stack several funds. They overlap and just recreate the market with extra steps. Simplicity is a feature, not a shortcut. What return should I actually expect? Honestly, nobody knows the future, and anyone promising a number is guessing. What history shows is that a broad U.S. index has averaged very roughly 8% a year over long stretches before inflation, with wild swings along the way, including down years of 30% or more. Use that as a rough long-term planning figure, never as a promise, and never assume any single year will look like the average. The average is made of terrifying drops and powerful recoveries. Index versus a single stock. Is it really better? Consider a simple picture. Buy one company, and your entire result rides on that one business. A scandal, a bad product, a bankruptcy, and years of your savings can vanish. Buy the index, and no single failure can sink you. The winners inside quietly carry the losers. You give up the chance of one stock making you rich overnight, but you also remove the chance of one stock wiping you out. For money you're counting on for your future, removing the catastrophe is worth far more than chasing the jackpot. That trade, no jackpots, no disasters, is the whole appeal. Index funds are simple, but people still find ways to trip. Let me save you the common ones. Trap 1. High fee lookalikes. Some funds are marketed as index funds, but charge 1% or more. Always check the expense ratio. Cheap is the point. Trap 2. Buying too many funds. Owning 5 overlapping index funds doesn't make you safer. They all hold the same big companies. One broad fund already owns everything. More funds just adds confusion, not diversification. Trap 3. The expensive one. Selling in a crash. Index funds go down in bad years, sometimes sharply. That's normal and unavoidable. The people who panic and sell lock in the loss. The people who keep buying through it historically recover and grow. An index fund only truly fails you if you sell it in fear. Held through the storms, it has rewarded patience across every long stretch of U.S. market history. And the honest limits, because I won't oversell. An index fund is not a guarantee, and it is not fast. It can drop 30 or 40% in a bad year and test your nerve. It does not make you rich this year or next. What it offers is something quieter and more reliable, decades of owning the whole economy at almost no cost, letting compounding do the work while you do nothing. It's a marathon tool, not a lottery ticket. Anyone who tells you it's exciting is selling something else. Its power is precisely that it's boring, cheap, and patient. So, an index fund is one cheap purchase that makes you an owner of hundreds or thousands of companies at once. It beats most professionals because it's diversified and nearly free. You buy one broad fund, keep the fee tiny, automate a monthly amount, and leave it alone through every up and down for years. That's not a beginner's shortcut. It's what a huge share of genuinely wealthy, sensible investors, and even Warren Buffett's own instructions, point to. The simplest tool in investing is also one of the most powerful. You just have to be patient enough to let it work, and disciplined enough to leave it alone while it does. Those two things, not intelligence, not timing, not a hot tip, are what separate the people who quietly get wealthy with index funds from the people who never quite start. An index fund is boring on purpose. One fund, the whole market, a tiny fee, an automatic monthly deposit, and years of patience. That's the entire strategy, and it has quietly built more ordinary person wealth than almost anything clever ever has. I won't pretend it never drops or that it makes you rich overnight. It will fall in bad years, and it rewards you slowly. But across every long stretch of history, the person who owned the whole market cheaply and simply refused to panic came out ahead of almost everyone trying harder. That option is available to you on your next payday for as little as $50. I'm Mr. Finance. Subscribe if you want more of this. Plain explanations, real numbers, no hype. And tell me in the comments, have you bought your first index fund yet? And if not, what's the one thing that's been stopping you? I read every single one.